Hello everyone. I will continue with the remaining part of chapter 3 in this lecture. So we have so far looked at retention as a way of risk management. Now we look at non-insurance transfer. In this case, a company will transfer its pure risk and the associated financial implications to another party. It could be through contracts like futures and options, as well as legal agreements like hold harmless agreement. So what are some of the advantages? The company is able to transfer non-insurable risk to a different company. It may sometimes be less expensive, and the loss is now absorbed by a company which is in a better financial position. The disadvantages are the contract could be ambiguous, so uh, the contract may not be properly enforced. Sometimes the other party may fail to make the payout when the loss occurs. So in that case, it becomes a credit risk. And sometimes insurers do not give credit for these kind of transfers. They consider the business as uninsured. The next method to manage risk is insurance. It is suitable for low probability and high severity loss exposures. So in this case, the company's risk manager will negotiate and finalize the insurance with an insurance company. They will decide on the terms and conditions for providing insurance coverage as well as the premium to be paid. The two things we must notice. The company goes for an insurance cover and it has a deductible involved. So let's say the company has taken an insurance cover for $5,000 with a $500 deductible. So the company will be compensated for any loss up to $5,000. But the payout will be less by $500 because of the deductible. The company can also opt for insurance, excess insurance policy. In this case, the company decides to retain some part of the loss, and over and above that retention level, the company goes for insurance cover. So in either case, the risk manager deals with the insurance company, finalizes the contract, the terms and conditions, premiums to be paid, and so on. So what are the advantages of insurance? The firm is indemnified for losses. So it is restored to its financial position prior to the occurrence of loss. Less uncertainty. Then there might be some tax benefits, and the company may also receive some additional risk management services from the insurance company. The disadvantages are the premiums may be costly. The negotiation between the company and the insurance company will take time. And after taking insurance, the risk manager may become lax in terms of enforcing risk management. As a result, some uninsured loss may happen, and that could lead to financial implications for the company. The reason being it is not covered by any insurance. So we look at this matrix, different levels of loss frequency versus different levels of loss severity. So for different combinations, we have different ways to manage the risk, either transfer of risk, retaining the risk, or reducing the risk, and so on. So when the risk manager is finalizing the contract with the insurance company, they must also be aware of the underwriting side, that is the prevailing conditions in the insurance market. The insurance market could be a hard market where the insurance company will have very strict underwriting standards. They will impose very strict conditions and also charge higher premiums. The insurance market could also be going through a phase of soft market. So in this case, the insurance company will be less strict In terms of underwriting, they will impose less strict terms and conditions, and they may also charge less premium. So these are some of the market conditions when it comes to negotiating or finalizing insurance. So the last step is implementing and monitoring the risk management program. So the risk manager needs to have a policy statement in place, inform the top level executives, train the new employees, so that everybody in the organization is on the same page when it comes to ensuring risk prevention or managing risk. Also, it is important that there is buy-in from other departments such as finance, marketing, production, and so on. Because all employees, all departments are involved in ensuring that the risk management is robust in the organization. So that is why the buy-in of all stakeholders, all internal stakeholders is important. So what are the benefits of the risk management process? The four-step risk management process. The company is able to achieve its pre-loss and post-loss objectives. The cost involved with managing the risk goes down in case there is a proper risk management program. Then it also benefits the society because the consequences of loss is reduced. So I will conclude by mentioning that an individual can also formulate a risk management program for themselves. So the individual needs to follow the same four-step process and figure out what would be the proper way to manage risk for themselves. That's all for chapter 3. Thank you.